So, the final keynote, it's a great honor and privilege to introduce our last speaker today. Professor Anat Admati is Professor of Finance and Economics at Stanford University. She's been very active in the policy debate on financial regulation in general and on bank capital regulation in particular. I will not spend a lot of time talking about Professor Anat Admati's impressive academic track record. I will instead focus my remarks on her forthcoming book. With Professor Martin Helvig, she has co-authored a book about what is wrong with banking and what to do about it. It's going to print as we speak and is expected to be in the market in a matter of weeks. So please allow me to just read a few of the praises that this book has already received from quite prominent people. Let's start with Mervyn King, Governor of the Bank of England. At last, two eminent economists explain in plain English what is wrong with banks and what needs to be done to make them safer. So this is Mervyn King. Eugene Farmer, famous Chicago school economist, often considered the founding father of the efficient market hypothesis, quote, "This entertaining book is an accessible exposé of the myths that financial firms use to perpetuate the advantages they get from government guarantees of their debt. A must-read for concerned citizens, this book should be studied and memorized by lawmakers and regulators so they won't be duped by these false claims in the future." Let's hear what Kenneth Arrow, Nobel laureate in economics, has to say. The book's clear exposition conveys a deep understanding of the pervasive place of banking in the economy and stands in opposition to the self-interested forces of obscurity. And finally, let's hear what Kenneth Rogoff says, author of This Time is Different, 8 Centuries of Financial Folly. "This is the most important book about banking in a very long time. Future efforts to regulate the financial system should start here." So this is what I suggest we do. Please a warm welcome to Professor Anat Admati.
Thank you very much, Jakob, for inviting me and for this opportunity, and thank you for being here. I will go right to what is wrong with banking. I believe the financial system is way too fragile and dangerous. I believe the financial system, I assess the financial system to expose the public to unnecessary risks. It distorts the economy in significant ways. It suffers from severe governance problems throughout the system. It is not regulated effectively right now in most countries, and it does not support the economy as well as it could. It's a very negative assessment, but I believe this to be true, and I will try to give you a glimpse of why I think this is the case. What makes this system very fragile? One thing is high leverage, indebtedness. This just makes them prone to needing the kind of resolution or bankruptcy that we talked about. They become unable to fulfill all their commitments to depositors and to lots of other people they made promises to. They also rely in particular not just on any debt, but a lot on short-term debt, deposits being obvious, but also a lot of other debt that are very short-term and very unstable, very fragile, and they run, as was discussed. So not only are they indebted, but they're indebted in a particularly fragile way. And everybody that gives them money expects to be paid or hopes to be paid somehow. In addition, there is fragility in the system beyond the individual institutions because these institutions are highly connected to one another, which gives rise to a variety of contagion mechanisms that is a source of this systemic risk that we talk about. And the systemic risk comes from simple contagion through contracts, the fact that they lend to one another and borrow from one another so that one falls, that weakens immediately through the contracts, the other people. In addition, there is information contagion. People learn from one failure about the viability of others, and there are asset sales, deleveraging that's extremely intense in a crisis. Everybody's selling. All of that we have seen, all of that we know. In addition, this system is extremely opaque and has lots of ways to hide the risk. We touched on accounting problems. One of the reasons that people get nervous is they don't know what's there. They don't understand what's going on. The disclosures are not to be trusted, and that's another source of fragility in the system. The minute people get a little nervous, they start running and doing all kinds of things that destabilize the entire system. So it resembles a set of dominoes standing right next to one another. You touch something very fragile. So they have off-balance sheet commitments that we mentioned, shadow banking. There are derivatives that we don't know what's going on. They're over-the-counter derivatives. They don't go through exchanges. Even if they went through clearinghouses, they are not enough in the light. We don't know what's going on. A lot of information is masked. Highly complex institutions. They are extremely distorted, unhealthy entities, okay? Some of them are considered too big to fail. Maybe they're too systemic, too important. Maybe there are too many of them. So it's not just the size. It could be the number that are all going to fail at the same time, as tends to be the case. So this situation creates implicit guarantees which are subsidies because they're not being paid for up front. So there is a huge amount of evidence that the subsidies are substantial, and of course they're very substantial in a time of crisis when the option to have your debt paid by somebody else is worth a lot. And it gives perverse incentives in this system to have the risk come in such a way that everybody will fail, or in a way that would make it impossible to resolve and put taxpayers and governments in the very difficult position of choosing between bailouts and resolution or bankruptcy or failure of some sort. This situation, and in particular the high indebtedness, leads to inefficient lending decisions. So already they are not healthy institutions in terms of the decisions they make on the asset side. They either lend too little or too much. They have biases, that was just mentioned, against the hard work of business lending, where we need them the most. They would rather have more fun elsewhere, invest in traded assets, do all kinds of things. All the trends show that, and some of it is the fault of the regulation, in fact. They want them to have liquid things, they want them to have certain risk weights, etc. So lots of things you can trace. They have severe governance problem. You could say that banking is a source, is the place where everything is a governance problem. Who makes the decision and who is impacted by the decisions? The managers make the decisions. The shareholders are affected. The depositors are affected. The creditors are affected. The taxpayers are affected. Who has control over those decisions? The managers have control over those decisions. They throw a bone to the shareholders sometimes in good times. The managers do the best. The shareholders do the second best. The creditors do not as well unless the government guarantees their debt, and the taxpayers suffer the most and pay the most costs. The public suffers collateral damage. So severe governance problems throughout this system. What to do? We spent a day on resolution. We want to be able to let them fail so that there is discipline, so that they are not too big to fail, so that the incentives get better. We want to do that. But this is before today, all these points came out today. What's the trigger? What happens? How do you do it? In any case, in the best of worlds, you don't want to go there if you could, okay? Distress is already harmful. So before you even get to insolvency, any hope of a trigger, certainly before you get to default, which might never happen with this liquidity supports, it's already an unhealthy system. You might also already have zombie banks not functioning. What to do? So that's how we spent the day as a solution. There are other solutions. We'll hear tomorrow in the keynote about structural reforms and proposals to, in the US, it's very popular now to say, break them up, break them up, break them up. We love Glass-Steagall, the good old days. What to do exactly and how will this help? It's not exactly clear. There's a Volcker rule. There are all kinds of ways to restrict what they do. But then who will do it and what will happen? Who is systemic? It's not clear. It's about depositors. So the investment banks become systemic. AIG becomes this systemic. So already putting inside the ring anybody you're going to guarantee and committing not to bail out anybody else already is not credible. Because we wouldn't have then, we would have let a Lehman fail. There was an investment bank. It didn't have deposits. AIG didn't have deposits, so it's not about deposits. Indeed, if you break them up, you have many, many ones that can fail at the same time, and the system might be just as fragile because it's interconnected still. So already Glass-Steagall was eroded before it was abolished, and it's not clear that breaking up or these structural reforms are actually going to deliver what we need unless we do a whole bunch more. Now, I want to give you two analogies to keep in mind as I go on. Think of banks as chronically sick, addicted, in fact. I will claim they're addicted to borrowing. It's a contagious disease, okay? And you can go to recovery plans, which amounts to emergency medicine, if you will, or corners that would put them in a grave. But instead what we have is a solution through safety net. The safety net feeds the addiction, is what it does. It makes them want to do these things ever more that they are addicted to. It makes borrowing more attractive and risk more attractive. Therefore, counterproductively, paradoxically, subsidizing exactly what we don't want them to do too much of, unless it's important. Analogy number two, think of banks as trucks driving through neighborhoods with loaded, dangerous content. They will tell you they need to drive really fast because that makes deliveries really cheap and helps the economy grow. After we have some explosions in residential areas, we might not believe that 100 miles an hour is a safe speed through the neighborhoods. We might institute a crude but low and safe speed limit. Instead, we encourage speed and reckless driving by policies that subsidize the fast driving of these trucks. Can we put these speed limits? Well, is it the case that financial crises are like earthquakes, something you cannot prevent, and it's just stuff happens? Jamie Dimon tells his daughter a crisis happens every 5 to 7 years, or they would tell you it happens every 100 years. Why do we have to worry about it? Everything's fine, go back to sleep now, they say. Do we need to have this system? Do we like this system? Does it work for us? Well, it can do some things for us, but is it doing really as well as it could do? The answer is no. Do we have to sacrifice anything to get this system quite a bit more safer than it is right now? The answer is no. They would not have you believe it, but the answer is no. We do not have to sacrifice anything that this system does to have it be significantly safer. We can reduce the fragility of this system dramatically without sacrificing anything at all. The social cost is almost nothing. I cannot hardly think of any. The social benefit is enormous. This point somehow got lost in the debate. What's the solution? Reduce indebtedness dramatically. It's called capital requirements. You'd think capital is some idle funds sitting aside if you didn't know what it was about. How about going straight at the heart of this fragility, the fragility of an individual bank, which feeds into the fragility of the whole system the most, okay? Because it's when you have solvency concerns about somebody that everybody starts running away. If there was, in fact, a resolution mechanism where somebody would lose. You could reduce the likelihood of distress and failure, and therefore needing the resolution mechanism. Mr. Valencia alluded to that. You can reduce the too big to fail subsidies by not allowing the subsidized debt to be used as much as it is and making the funding costs more appropriate and more economically like what they should be. You want to shift the downside risk from the public into the private markets, into the equity markets, in fact. Why into the debt market is not clear, which is all resolution is about. You can reduce the likelihood of liquidity problems as well, because liquidity problems usually do not happen in a vacuum, and they often are tied to solvency concerns by somebody. You can reduce the likelihood of a credit crunch, because it's when institutions are highly indebted and highly distressed that they stop lending to one another and to the public. By changing the funding mix, you do not interfere with anything that the banks are doing, because even their liquidity creation can be supported, and in fact would be even better if it was backed up by people who bear the downside of whatever they do with that money that they borrow from other. It is the best bargain in town, and we put ourselves in the box of where we spend all day to feel that here we are, stuck. We're not as stuck as we are. We put ourselves in this position. We could change it. We just missed the opportunity so far. It's never too late. We don't have to wait till the next crisis. Equity absorbs losses, and it lowers the chance of distress. Here is a loss. Here is distress and insolvency. Balance sheets, whoever puts the numbers there, whatever. What happens to this? You might need to recapitalization. We might not wipe out the equity. Equity is still there, okay? In the other one, we wouldn't. There would be some left over. Leverage in banking has increased. Indebtedness has increased dramatically over the time, over the last 100 years. Charles mentioned this. In the 19th century, banks were unlimited liability partnerships, and equity was about 50% of the assets, no regulation. And that was to make the banks trustworthy. There was a liability of the owners, okay? Of course, no rich person would invest in banks because they would be personally liable. And banks were like the last entities to have limited liability because it was understood that that would make them less trustworthy. Banks in the US did not have limited liability until after the Great Depression. Most states had double, triple, unlimited liability for bank. And so if the notes were no good, the shareholders the owners were charged with making up some of it. And in banking crisis in Glasgow in the 19th century, it was the shareholders that got wiped out and not the depositors or the creditors, okay? So here's the picture, equity ratios, and this doesn't go all the way to the middle of the 19th century. Equity ratios decline dramatically, and in the original paper that Dick Herring was one of the authors, there were lines put through this because it was just the US for safety nets that were put in place to show the more safety net, the more indebtedness. So all of a sudden the debt capacity increased, that became the favorite way to fund, and they could borrow because people gave them money, subject to the safety net. So here we were in the single digit now, coming into it, and then more and more ways to lever, derivatives, other things. Why do we have this trend? Now, I'm not a banking expert, or at least I wasn't until 3 years ago. So where I come from is Stanford University, Silicon Valley. Banks are not important in my part of the world. Venture capitalists are more important. High-tech companies are more important. And they don't use so much debt. So the question you have to ask the next time that you or the banker says that equity is very expensive, a hated word in banking, you have to ask, why is it that all these companies that we don't regulate at all about how they fund don't choose to borrow very much? They too can borrow. There are the markets out there. Why doesn't Apple bother to borrow anything at all? Why most companies stay well in the vast majority of their funding come from retained earnings and equity? Obviously, they find people to invest in their risky equity with no regulation. They could also borrow at some cheap rates. Apple can borrow for almost nothing. Somebody asks, what is a safe asset in the economy? I say the first $1 billion that Apple borrows, that's a safe asset. If there ever was one, safer than government probably. So in this graph, you see the indebtedness, the different industry, you see the high-tech industry, you see all kinds of industry. Nobody in the economy is as indebted as banks, and neither the institutions we need to be safe. They choose not to. Do we have to let them? That's the question. Basel II had 2% Tier 1 capital. That's not even equity. And in Basel III, that got tripled to 7%. Tripled to 7% of risk-weighted asset. Okay, this can go below 3% for some of the banks. Okay, big innovation that we have a leverage ratio of 3%. 3%. This is paying $9,000 to buy a $300,000 house. That's like a subprime borrower is the banks. This is how much loss absorbency they have. This is how much they can absorb without becoming insolvent, let alone distressed. What would be prudent? How about going back to before the safety net? What's wrong with 25%? I've been asking this question for about 3 years, and I have gotten no good answer. None. I challenge you. Basel allows 3% equity to total assets. There is absolutely no reason in the world, do not believe a word of the justification for that. It is not justified at all. There's no reason for it to be so low. This reflects things that I'll talk about at the end. Martin Wolf had a word for it. Tripling the previous requirement sounds tough, but only if one fails to realize that tripling almost nothing does not give one very much. So we went from almost 0 to 3 times almost 0. That's where we are. So they live on the edge. Here you are, another analogy. You stand at the edge of this canyon, and somebody says, why don't you step back? Say, no, you have to give me a calibrated model to tell me that I need to move back, 13.753 feet calibrated, otherwise I'm staying right here. Here is the situation. Here is the bank. It makes loans. It needs funding. How can it fund? It can fund with equity. There's no problem making loans with equity money. It can also fund with debt. There is the river, the rest of the economy. When it funds with too much debt, there is pollution on the rest of the economy. More systemic risk. Okay? There's collateral damage. What do? We have subsidies for debt. How do the financial firms respond? Competing with one another to make more profits? They choose a lot of debt and a little bit of equity, and we get more pollution and more systemic risk. Does this make any sense? We have happy bankers, high stock prices for banks. Do they pass on these subsidies? It's not clear. They certainly take off the top. Cheap credit? Maybe too cheap. What's the right price for things in the economy? Here is how it looks, and here is the conflict of interest between bankers and society. For the banker, from where they are, they love to fund with the next dollar coming from borrowing. Why? It's subsidized through the tax code. That's about the craziest thing we could do. A tax is like send them a bill. Why does it have to be a function that encourages leverage? That makes no sense for banks. Abolish the deductibility or settle with them without having true leverage. Just pretend that this is the leverage for the tax code if you want to neutralize it. But don't have them become indebted in order to take advantage of tax subsidies. That makes no sense. Taxes are public money. So that's a completely crazy tax code in most countries that allows and encourages indebtedness for everybody, and yet for the other companies, they don't go for it, okay? But it's another thing, it's not the reason. Safety net benefits, obviously, just even explicit guarantees, even if they pay for them on the margin, borrowing is better. They have a fixation on return on equity. I'm not going to go into that, but that is one of the sickest things in banking is the nonsense around return on equity. Return on equity has no space in this debate at all. Raw return on equity. That has nothing to do with anything that we're talking about here. It doesn't even have to do with the bank's value creation unless you adjust for risk. There are many ways to take risk in the world and get rewarded. That doesn't make for value, except for extraction of subsidies, of course, or bonuses. And then you have a debt overhang effect. The debt overhang effect is a reason that borrowing in general is addictive, can be addictive. The borrower will not prepay, just like a classic debt overhang problem, even if reducing indebtedness benefits the total balance sheet. From the perspective of the equity holders, of a borrower, the borrower, just like they become biased towards more risk, they become biased towards more and more borrowing, because by using equity, they bear more downside that otherwise, with debt in place, is borne by creditors. This is even without subsidies or safety net. This is any borrower that gets to this point of being highly indebted. Take our homeowner that borrowed a lot. They will not prepay the mortgage. They will not reduce the indebtedness at their own expense. That gives a gift to the creditor. Just like any positive net present value loan benefits the creditors, and that's why they avoid loans in distress. That's a debt overhang effect. So you get all these inefficiencies of debt right there, including a resistance to equity once you're highly indebted. So you kind of become addicted. You need to be pulled out. You will not choose to reduce your indebtedness on your own. And you will fight the regulators and everybody who will tell you to reduce indebtedness. This is the private consideration of the banks. None of these reasons for which they love debt represents a cost on society of them having less debt. None of them is a social reason. The only thing that works for them is the fact that they can put some of their costs on other people. That is not a social cost. We do not have to allow this just because it works for them. That is just like the river polluter telling you that their costs are lower if they pollute the river, and they will price the dye more cheaply for you, maybe. For society, it looks completely the opposite. Starting from a point, say, where we are, equity provides enormous benefits to society, that there would be more of it. Okay? All these advantages that I gave make the funding of banks be precisely not where it should be, given where we are. I'm not talking about 100% equity. I'm not talking about reducing any indebtedness even. You can add equity. You can make them add equity. This is how the rest of the world funds. Most firms fund with retained earnings. First and foremost, this is the biggest source of funding for firms in the economy. It's called the pecking order of corporate finance, and it's retained earnings, but not in banking. They want to pay it out. This is another manifestation of a conflict of interest between creditors and borrowers. In general, the borrower wants to take the money out, wants to remain highly leveraged. That does not make it a good thing that they would deplete their equity, and it makes it a very bad thing when regulators allow them to do that. One of the things that's wrong with banking is the approach of always delaying and never recognizing the reality of the banks. So we have a situation in which a lot of losses are not recognized by the accounting rules, by the banks themselves and by their regulators, and therefore we have market values way below book values for many banks, and effectively the market is saying the banks are weaker than they tell you they are. And this is including the subsidies already built in. So it's quite possible that some of these banks, as some people argue, are insolvent, are zombies right now. Yet we don't employ these resolution mechanisms. We must not trust them enough yet. But it would be a good attempt to take one of these zombie banks and try it on them one of these days. because they probably are not healthy. Zombie banks are very dysfunctional. They do not make good loans, they roll over bad loans. All these things got a little bit touched on during the day. They are not healthy. They were not healthy in Japan. It was even mentioned by our Japanese host. This is not a good thing to maintain. Instead, kicking the can down the road is common. Supporting banks that are unhealthy even is common. Calling it liquidity support, it's always liquidity in banking. This is the narrative that the distressed borrower likes if they can avoid default, is to tell the creditors it's just a liquidity problem. Any moment I will have the money back for you, just roll it over one more day. That's the narrative that is accepted by regulators and other authorities to deny and ignore the reality of the weakness of the banks that have done all kinds of things in the past, whatever they are, and yet we are going to not recognize those losses. In the US, this leads to incredible inefficiencies throughout the economies. Mortgages are not renegotiated because they don't want to recognize the losses. There are second mortgages that will be total losses to the banks that they just hold in their books. A bank analyst said there are $300 billion of unrecognized losses in US banks, and we just pretend that they are stronger than they are. Book values higher than market value, and they think that's the right value. Equity is expensive because we don't pay them their book value. Sorry, the market puts a number on it, and that number might be more appropriate than the book value these days. In fact, that number still includes all kinds of subsidies built into this, into the effect that the equity can sort of get back to life and have some good days and some dividends again. The view that every problem in banking is a liquidity problem is highly dangerous. And so this blurry line between liquidity problems and solvency problems and what comes first, which obviously there is some connection, is a very flawed approach. The fact that you are going to interpret every difficulty of a bank as only a liquidity problem without needing to go and see their actual strength or weakness. Solvency problems are much more dangerous. They make the banks a lot less efficient, and they support the economy a lot less. So keeping and maintaining alive institutions that really should not survive is bad and creates excess capacity in this industry, which we just don't know anymore what it should be. So that's another source of sort of sickness in this industry, that there's too much supporting of non-viable banks. It's not clear that every business in the economy needs to exist, and we don't support every business that just puts a shingle. But in the US right now, and these are small banks, so I'm not going after Jamie Dimon for a change, the small banks come and say, you know, I'm a community bank, I'm a mom and pop community bank, and what they are, they invest in commercial real estate, funded with deposits. If it doesn't work out, they walk off. It's not clear that all of them need to be. It's not clear they have an efficient scale either. It might be too small. So we don't know because there's just too much safety net. Too much safety net. They do not face the reality of funding and the reality of investment that the rest of the economy has to live by. And the objective should be to get to wean them from so much safety net. We've gone too far on the safety net. They should be bearing their own losses a lot more. There is much more capacity to have people bear the losses if they have a good business. If they do not have a good business, then maybe they shouldn't be. Maybe there are too many of them. Maybe there is a total industry is too big. What's wrong with Basel III? The levels, I said, the adjustment period is way too long. There is no need. I mean, in the same Martin Wolf column, he said, oh, the adjustment period is till 2019. By then, we'll have a couple more crises. And he didn't even know about the European crisis coming up. So this was in 2010, before Greece. So there is no need to wait. There are either viable banks or non-viable banks. If they're not viable, we should know that. If they are viable, they can be strengthened pretty quickly. There is no reason to wait. The regulators have to be a lot more proactive. Giving them ratios is not even a good thing, because there might be some unintended consequences to that. No, instead you have to direct the transition. First and foremost, you have to ban these payouts. The payouts are completely in conflict with society. The shareholders of the bank, that's me and you, I hope. Majority of the bank shareholders hold diversified portfolios. I do not want those dividends. I want them to be stable. Those that are concentrated their lives on the bank, their bank managers, it's just too bad. If they tell me that they do not benefit from guarantees, then the cost will not increase. It's just that they are taking the downside risk from their creditors or from the deposit insurance funds, and there shouldn't be a big deal. And they may be paying a little bit more taxes for moving from where they are to a much better place. Okay. Basel levels are too low. And in addition, Basel relies on a system that has failed miserably, that has contributed greatly to the instability of the system, that has caused more interconnectedness and more flawed investment, concentrated invested in AAA things that the regulation viewed as safe. Anything that the regulation views as safe but is actually risky and pays accordingly, that's where the banks go. It biases against business lending. It creates all kinds of innovations to get around the regulation. It uses the bank's risk models. It is a flawed approach, the whole thing. I'm not saying necessarily that there is a clear objective. I'm just saying we need to recognize that this approach did not work, and just tightening the screws on this approach is not going to help us. There's political process about the zero risk weights and sovereign bonds. This is how Dexia failed on Greek debt as good as cash after passing stress tests. Okay, so models are trusted. They shouldn't be trusted. Also, it trusts non-equity capital still, even though, as was already mentioned by a question and otherwise, nothing is as reliable or as even near as reliable as equity for loss absorption. But beyond that, I come at it from the point of view of debt overhang. Anything that is debt-like has a debt overhang problem. Anything, preferred as well. U.S. government coming to capitalize the banks with the preferred debt added to their indebtedness, because they come after those who make the decisions. They come before those that make the decision that already biases against certain loans. Equity is the most reliable and the best for the banks. Risk weighting, okay, so where am I? Okay, I just want to say something about central banks. So this is a conference about central banks, so I want to have one slide about central banks. Central banks are on a slippery slope. They are lenders of last resort, but what's the collateral? Is it Greek debt? Is it any mortgage security? It's a slippery slope to disguised bailouts. The supports of the Fed were mentioned today. They were unbelievable, and they fought to hide them from the public. So that also got mentioned today. It's a blurry line. Are you supporting the banks? Are you supporting the governments that want the banks to lend to them? This is what's happening in Spain right now. As regulators, some of them are regulators, some of them want to be regulators. The issue is they have lots of objectives, and its financial stability often gets lost. So my bottom line is an uplifting one. Financial reform is possible, also essential. The depressing part is, are we doing it? Banks are not fragile because they must be, but because they want to be and get away with it. That's basically the situation. They are basically taking actions and harm others, and it is the job of policymakers to protect the public from all this risk. The risk of borrowing is entirely unnecessary. Everybody can take risk, but not add to risk, magnify it with leverage. Basel III is flawed and insufficient. We can do a lot better, but we already can do a lot better. Basel III is just a minimum. Any country can go above it. I encourage every country to race to the top and not to the bottom of these regulations. The level playing field arguments are flawed as well. The sad state of financial reform is that this particular reform that is the most cost beneficial of all is somehow lost. Nobody talks about it anymore. Basel III is considered so harsh and so terrible when it in fact so incredibly insufficient and flawed. The debate has been muddled by a lot of flawed arguments. ranging from nonsense about the language that's used all the way to basic fallacies to theories that don't describe what's going on. Here is just one quick example. This is a typical bugbear. This is what you hear in Denmark and anywhere. Growth will suffer. Touch me and growth will suffer. In a book recently, Paul Volcker is quoted as saying that anytime you want to do something to the banks, they'll say, oh, credit will suffer, growth will suffer. Where, by the way, lending is not what they do on the margin. This was already mentioned. So lending will suffer. There's no problem with availability of funds. They have plenty of funds. JP Morgan lends 700 billion, but it has $1 trillion of deposit and another $1 trillion of other debt, according to US standards. By other standards, they have more. So this is a classic statement from Ackerman. Oh, we have a big trade-off. We can have safer banks, but we have to sacrifice. Here is the statement, edited. Well-designed capital regulation that requires much more equity will increase the stability of banks. At the same time, it would enhance their ability to provide good loans, not any loans, good loans, to the rest of the economy, and remove significant distortion. This may reduce the growth of banks. However, it will have a positive effect for all, except possibly for bankers. So that's basically what I have to say about those threats. And so if you didn't understand any of my claims or thought they were completely outrageous, Martin Hellwig and I take you from knowing absolutely nothing about this. And if you're an expert, we have other writings that are a little bit more advanced that we've been writing about for the last 3 years. So this book is meant to alert people to the missed reform and to the sad state of financial reform and to the danger to society that remains from this state of affairs where banks can grow and endanger us. And this is the website, and it's supposedly on Friday it will be in the warehouse. Thank you very much.
Thanks a lot. So I'm conscious of time, but I think we can take at least 10 minutes for some questions for Anat. And I have the first already here.
Well, thank you for your bright and very interesting presentation. In fact, I agree with you. There is a huge problem with banks, and there is a strong need for a different regulation, much stronger regulation. And I'm like you, very critical with respect to the Basel regulation, the way it goes today. But I have two critical comments, if you accept. One is that your main argument is to say we need to reduce the leverage of banks. Hence, we need more equity on liability side of banks. But what is lacking in your analysis, it seems to me, is the analysis of what we may call the shareholder capitalism. Because today, banks and firms have shareholders to pay, and they have a return on equity, which you dismissed as something not very important in your presentation. And some banks today have a return on equity, and in recent years at least, around 20%. And in my analysis, this payment and this remuneration of own funds, which creates this excessive risk-taking. So if you ask for more equity in this shareholder capitalism, you will have more excessive risk-taking. This is my first point. May I give you another point? I'm very surprised that in your presentation, very pedagogical presentation of banks, you say nothing about one of the major roles of bank, money creation. Nothing, from what I understand. And this is extremely important because, one, it is a very important role of bank, and second, it explains the asymmetry between liability side, where you have the deposits, money created by banks, and the asset side. So you need, in all banks today, and in the past it was the case, you have this asymmetry, which is the cause of the fragility of banks. So all banks, in fact, are by nature fragile. You cannot say we cannot have banks without any fragility. So I'm very surprised that you don't introduce this type of analysis. If you want to explain what is a bank to children or to people who don't know about banks, you should introduce this dimension. It seems to me extremely important.
Okay, I would like to respond to the 2 points there. We cover them both in the book. On governance and shareholder governance, I share your concern that somehow they will still want to deliver the same return, and therefore they will be more reckless for that. Shareholder governance is a big problem. Now, if it is a problem still in banks, I have another paper in which I propose holding the capital away from the bankers, okay? Because they're regulated anyway, there are ways to resolve that problem. In other words, what I want is I want to see what the problem is, and if the problem is governance, let's address that without subjecting the system to the fragility of the bank. So I share your concern that shareholder governance is a problem everywhere, but it's a problem in other companies as well, and they are more buffered, okay? And they still choose to be more buffered, maybe because the managers like it, I agree. In the rest of finance, we have a zero leverage puzzle, why companies don't borrow more, but they still accept an LBO. Now, money creation, I will have to ask you to read chapter 10 of our book, because the chapter asks, must banks borrow so much to be banks? In other words, the liquidity creation of banks, I do not touch. I asked them to back up. I asked what happens when they take risks, who bears that risk? I want them to back up whatever money they create. And the point we make is the following. Money creation in the sense of printing money is not something banks do. Only central banks do that these days, okay? Banks, in their liquidity creation, are more trustworthy when they bear their own losses. Everybody trusts them more. So this function of liquidity creation will only be enhanced by more equity. Those that talk about money creation forget to ask the question, when they produce the money, what happens when risk is taken? And who bears those losses? The more the bank equity holders bear those losses, and therefore protect those who are counting on banks for liquidity and safety, the better off the liquidity function is, actually. So there is no contradiction between liquidity creation and what I'm saying. I don't even mind that banks grow if there is such demand. What I'm saying about liquidity creation is that you might get too much of it if it's mispriced. In the current safety nets, it's mispriced. As long as it's priced correctly, I'm happy to allow liquidity creation as much as the market needs liquidity. But our contention is that the demand for actual money, cash, is actually small. People want return, but they also want everything. And corners are cut on the search for that. For safe money that pays interest, that's too good to be true, usually.
Okay, thanks a lot. I have a question in the far corner here.
Yeah, just a couple of questions and associations. One, when you look at sort of the return function of Fred Goodwin, the former boss of UBS, I mean, you could argue ex post that he got it wrong in the sense that Fred Goodwin's incentive, if he had got it right, was not to take the kind of risks he took. And maybe it was because corporate governance was too good that he actually ended up taking the risk he took, because those who had the advantage of the excessive return were the shareholders and not Fred Goodwin. And Fred Goodwin lost his job when he got out the other end. So maybe there's a question, is the problem in banking that shareholders got too much governance and put too much pressure on CEOs compared to what you had in the 60s? That's one question. The second question is, I'm not quite sure where you end up on the lender of last resort of central banks. I would actually claim that this whole thing started as a liquidity crisis. And because we didn't contain it early enough, that was why it developed into a solvency crisis. But what are your lessons for central banks? Should they completely stop being lenders of last resort, or what should they do? And thirdly, when you look at sort of going back in history, even before the safety net, I mean, if you read, and I'm sure you have, Bagehot's Lombard Street and Thornton and all of those, I mean, you will see a century of banking crises, but also in England, which developed because of the banking system, and banking crises when equity levels were much higher. So when you look back at that history, are you sure you will cure it, and is the only problem the safety net?
Okay, do you want to answer right away?
Oh, whatever.
Let's take one or two questions more. I have one here. Yep.
Thank you very much for the presentation. I really enjoyed it. Question is, one stylized fact you emphasized was the reduction in capital, which covered banks. The other stylized fact which I wanted to ask you about, is reserve ratios, which have historically fallen. Why didn't you mention this as a very important policy which could be revived in this current context?
Okay. There's one last question. We have time for one more question, and then we have to allow Admati to respond, and I'm afraid that will have to be it because we're already a couple of minutes over time. So one last question. Manmohan Singh.
I'll just keep this short. So let's assume you do get your 25% equity. As banks shrink, it is very natural that these liquidity balloons or activities will go somewhere else. Just hypothetically, you gave the example of money, and now there have been at least half a dozen papers out of these AEA meetings saying that the public good should be to produce safe assets, which means it becomes a taxpayer liability through the central bank balance sheets. So how do you draw the line? This guy shrinks, and how will something else not take its place?
Okay, let me try to respond quickly on all these points. Obviously, I have more to say, and some of the things I didn't talk about was because I already didn't have time. So there's never enough time when I talk or when I write an op-ed, so I wrote a book. So governance is a problem always for corporations, and it's a problem for other people. So you might wonder why there's no contracts being signed, why the governance is what it is, why shareholders agree to listen to these flawed incentive contracts and agree to pay managers in that particular way when they in fact might be exposed to risks that they are not properly compensated for. The managers stack it up so they take the bonus first, recognize earnings, etc., and then the shareholders are left with everything, misconduct, everything else, and all the risks that turn out later. So as I said, banking is a big governance problem, and it does include shareholder governance. But that is not enough to harm all the other people that are harmed. So somehow we have to come to terms with the governance problem, and if we need to intervene on the governance, we should as well, okay? Because the shareholders are still benefiting disproportionately from the upside. What was the other question? That was the problem, is that I forget what the questions were. I remember the last one was about shadow banking, collaterals. Oh, liquidity. Oh, it's solvency versus liquidity. So we take in the book the narratives of the crisis that it was only a liquidity crisis. We disagree with those narratives. Liquidity crises don't happen in a vacuum. You could read, both Reinhard and Rogoff and even Larry Summers from 2000. You do not get runs out of the blue. There is a concern. There's a lot of uncertainty about those balance sheets. So point being, if the banks are going to make investors more comfortable with what they are doing, then we will, and in fact they are solvent most of the time, then liquidity problems are not a problem, and I don't mind liquidity supports. I don't want inefficient runs. So, but I disagree with the proposition that the problem starts with a run on a bright day, and then it becomes a solvency problem. I do disagree with that. Usually, even in the Depression, investors knew very well which banks were weaker or not. So there's often a structural weakness. If you talk about liquidity problems coming as sort of, plumbing problems or something like that, the question is why they started. So the deeper question often is, what was it in the system that allowed the risks to build up? Why are we having these problems? If they're pure liquidity problems, I'm happy to solve them. So a liquidity problem is I owe somebody at midnight $1,000 and I have a lot of money in the bank. That's a pure liquidity problem. There, we will solve that problem. No defaults usually happen from pure liquidity problem. It's when you start getting into concerns about solvency and a fragile structure that you start getting runs. So I argue that it usually has a distress fundamentally in there. So that's on that. And then I answered that I do not object to liquidity supports because runs can be inefficient. And people just want the money out to be sure, and that can create insolvency. So I'm not denying that runs can be inefficient. And I'm not even denying deposit insurance. I just want to shift the balance more to the private markets than what the banks want it to be. The question about reserves, well, obviously, reserves are most reliable form of liquidity, more than mortgage securities that can dry up in a flash. And so liquidity coverage is problematic, and we saw that. And the point is that I am trying to stay off that side of the balance sheet. Because reserve, unless you pay interest on reserve, reserve is costly. There's an opportunity cost for the funds. So I am saying if you're using equity, the money is invested at all times, and it absorbs losses. So the buffers that you hold on the right-hand side, their actual reserves, they have an opportunity cost. They're not being lent out. The equity is lent out. So when they say I can't lend when you have more capital, they're implying that it's on the wrong side of the balance sheet and confuse everybody with that. It's money out of the economy, all kinds of nonsense are being said about this. So, but obviously for the day-to-day, reserve is important, and in fact, probably, some reserve is the complement of equity capital. Anything else was?
Did you?
Shadow banking. And collaterals. Again, I didn't have time to talk about that, but I will only say this. The notion that because they go into the shadows, we don't regulate. In the book, we give the analogy of not outlawing robbery because the robbers go to the dark alleys, or not collecting taxes because people have tax loopholes. This is an enforcement problem. The fact that we failed to enforce the previous regulation is not a reason against regulation, because otherwise we just give up. If you're saying I can't regulate because I can't enforce the regulation, then regulation is impossible. You must enforce. You must take up this challenge and decide always to try to be a step ahead of the loopholes and all of that. Now, and who is included? Watch the system. If they tell you the risk went away and it's all in AIG, then you have to go there where the risk is. It didn't disappear. It just went away outside the system, outside your flashlight. Now, collateral, I would only say the following. In the US right now, repos, derivatives have an exemption from bankruptcy. This is highly destabilizing. This is one of the enablers and rehypothecation of encumbering the balance sheets, and you know that well, okay? So this only makes it so that nobody on the balance sheet of the banks cares about the risk, because everybody's got something or an insurance. And so it becomes a problem that everybody's feeling good enough to give them their money. And they become so indebted. In other words, in the rest of the economy, nobody could even borrow so much if they tried, because the creditors will not go for it. The creditors of the bank are easy on the banks. Hence, the banks hate those pesky equity holders that worry about the downside a little bit more. And so instead, they go yell at the regulators for not allowing them to borrow as much and have as much fun. So to say that we need a lot of collateral is to say they need to borrow so much. I disagree with that. In other words, if you don't borrow as much, then your need for collateral also declines. So I just want more equity funding. They hate equity, but it's a visceral thing. And some of the reasons they hate it, they don't even understand that it's not as costly as they think it is, because it's not measured by rate of return. That's just a fallacy we know for 50 years. So, maybe chapter 7, they'll read my book and learn.
Okay, so thanks a lot to Anat. Thanks a lot to all of you.